Hi, this is Richard Vague with Tycos. Today we have one more video on money creation. We don't mean to overdo this subject, and next week we promise to get back to other things. But the misunderstandings here are so profound, and there has been so much bad policy as a consequence, that we believe today's thoughts are a necessary addition. Last week, we saw that in the U.S. since 1950, 6 out of the 7 times that interest rates went down by 200 basis points or more, inflation actually fell. And that 3 out of the 3 times government debt levels exploded, inflation also fell. So we have this strange situation where even though the belief that lower rates or higher government debt both lead to inflation has almost no support in the data of the post-World War II era, most people continue to believe that they do. One explanation for this widely held misconception, perhaps the only one as far as we can tell, goes back to the world-famous episodes of hyperinflation, such as the Weimar Republic in 1921, the American Revolution in the late 1770s, or in the small, less developed countries more recently, such as Zimbabwe, famously from 2007 to 2009. So back to the U.S. for a moment. Between 2000 and 2025, $18 trillion in new money, or deposits in currency, was created in the U.S. $15.5 trillion of that $18 trillion was created by bank lending. Loans plus the securities that banks purchase, which are effectively the equivalent of loans. Pure and simple. The bank makes you a loan, they deposit the money in your checking account, and that very act is the creation of brand new money. Now, $4.3 trillion, which is a much smaller amount, was created by the Fed through the act of buying securities from the private sector. That's something called open market operations, sometimes referred to as QE or quantitative easing, and it is the very thing that some people refer to as printing money. And by the way, a technical note, other banking activity actually reduced deposits by $1.6 trillion. That's how you reconcile that. But none of the creation of this $18 trillion came from any actual printing of money by the government. Note that government debt that is issued is not money. Try spending a government bond if you don't believe me. So there are 3 ways of creating money: bank lending, open market operations, and the actual printing of money. And these are technically 3 very different things, and we'll now show you why. The rampant, irresponsible levels of money printed in the Weimar Republic in 1921, in the American Revolution, and in Zimbabwe was the literal printing of money. The government printed it and then handed it to the vendor or employee as payment. That was neither bank-created money, loans, nor central bank open market operations created money. Here's how you can tell the difference. When a bank creates money, it increases the amount of bank loans and bank deposits. You can easily see that in the easily attained data on aggregate bank loans and aggregate bank deposits, which, as you'll recall, are simply 2 sides of the same coin. Banks won't make loans and thus create deposits unless there is a legitimate demand and they feel like they'll be paid back. Even in those famous periods when banks were profligate in their lending, loan growth, and therefore the related deposit or money growth in a given year was never more than 8.1% nominally, in real terms very much lower than that, and generally speaking, very much lower than that. So the very need to be repaid for the loans that are made is a natural constraint on how much money banks can create. Next, when the Fed creates money through open market operations, we can also easily see it and keep track of it because it appears on the Fed's balance sheet, which is published weekly, and if it grows at all, it brings howls of protest and oceans of scrutiny. That process is governed by a largely independent board of 7 governors who serve as its watchdog. Money created this way has never grown by more than 8% of GDP in a given year. That board governance and that public scrutiny has acted as a constraint on the amount of money the Fed can create. In stark contrast to these two, we come to the literal printing of money and the payment by the government of vendors with that money. First of all, it's no longer legal, but in the past, in periods in which it was employed, it appeared as a receivable on the Treasury's books, not on the Fed's books and not on banks' books. Importantly, it had no natural constraints. This is exactly what happened to help fund the American Revolution. In it, $482 million in then issued currency called Continentals, you probably heard that, was printed between 1775 and 1780. I've included in this number currency printed by the states, by the way. That was going on simultaneously. GDP during this time was only about 200 million. So that new currency equaled roughly 40% of GDP for 6 years in a row. In the USA today, that would be the equivalent of printing $12 trillion in literal new currency for 6 years in a row, an inconceivable event. And nowadays, there isn't even the legal mechanism for this to happen. In the American Revolution, we just wrote a book on this, so we're up to speed. In the American Revolution, Superintendent of Finance Robert Morse's record keeping for all of this was in shambles, and it took him years to even get those records in good order so that folks could even examine them, though Congress perpetually hounded him for these records. By 1780, so halfway through the war, Continentals were no longer of any value, and the desperate founding fathers, lacking an alternative, created the nation's first bank in 1781 to help fund the war. They switched from Treasury printed money to bank lending created money and borrowed from that bank less than $1 million. See the vast difference between those two? $482 million in a type of money creation that had no constraints, the Continentals, versus $1 million in loans from a bank where there was a constraint. We pull that off in large part by simply spending a whole lot less on the war, since by that time we had determined that all we had to do to win was to not lose. And in fact, that bank's president, Thomas Willing, actually turned down the U.S. government on a requested loan, which, by the way, was a shock to Morris and the U.S. government. But that's another story. The Weimar Republic did the same mass printing in 1921 and 1922, but far worse. In an economy that measured less than, let's say, 40 billion marks, the German government printed trillions of new marks. That was amount far over 1,000% of GDP, as did Zimbabwe in the late 2000s. Its economy was around 60 trillion Zimbabwean dollars, or let's call that about 11 billion in US dollars. But from 2007 to 2009, it printed well over 100% of GDP in de novo currency, totaling hundreds of trillions of dollars. In fact, it famously printed a $100 trillion note. So for those of you using those examples as your proof that printing money creates inflation, we agree with you. It's just that in the current era, the U.S. does not create money that way, nor does any developed economy. Instead, their economies create money through banks and open market operations, and rarely in amounts that exceed 5% of GDP in a given year. Both bank and Fed-created money have constraints. The literal printing of money in the periods we examined did not. The U.S. has actually not had that many bouts of high inflation over its full 250-year history. The one common element among those has been the collapse or major constraint in the supply of some good. That happened most often in major wars where there was broad constraints or destruction of supply, but it also happened when OPEC notoriously ratcheted down the oil supply in the 1970s in protest of U.S. support for Israel, an event followed by the disruption that occurred from the 1979 Iranian Revolution. And it happened in COVID when factories simply had to shut down for an extended period and took far too long to get back up to full production. For developed economies, inflation is not a monetary phenomenon, but a major supply constraint phenomenon. So let's circle back to the issue we started examining 3 weeks ago. We've shown that neither rising government debt, nor money creation, nor the lowering of interest rates bring inflation. It is instead major constraints or destruction in supply that does that. So let's not use inflation as an excuse for not lowering rates. Next week, we'll shift gears and have an update on China's economy, where very interesting things are happening. Thanks.